welcome to Moneycontrol. You have tuned into IPO Watch and I'm your host Nickey Mirchandani. Well, today we're going to be talking about specialty pharma and healthcare integrated maker, that is Blue Gelt Healthcare, which is going to be hitting in Dalal Street on October 25th with an initial public offering of around 840 odd crore. That's the fundraising size. The IPO consists of an offer for sale only OFS component of around 2.4 crore equity shares by promoter, and there is no fresh issue proportion. But to know more about the company's strategy, we're being joined by Shiven Arora, who's the managing director, and VK Singh, who's the CEO of the company. Well, festive greetings there and afternoon, gentlemen. I'm going to start off by asking you more about the company. It seems to be a little diversified right now. Contrast media, sweetener, pharma intermediaries and API business. That's the split around the segment. What exactly is the company doing right now? Where is the focus point and what's the strategy going ahead?
Festive greetings and thanks for having us.
Pleasure.
So our focus has always been the regulated markets since the early 1990s. So we believe, as a company, we believe in doing something which is complex with little to no competition. And we work with multinational generics and innovators of the world. We have three business verticals. Vertical one is contrast media intermediates. So we make intermediates for dyes that are injected in the body to enhance the visibility of organs, tissues, blood vessels, and they are injected in the body before a CT scan or an MRI. So we make intermediates for all product classes, which is about 70% of our business. Artificial sweeteners is a high-intensity sweetener that we make, saccharine and its salts, which finds its application in oral healthcare, beverages, pharmaceuticals. And third vertical, which is about 5% of our business, is pharma intermediates, again focused towards innovators of the world, towards next-gen medicines in chronic therapeutic areas of oncology, CNS, and cardiovascular health.
Sure. I just wanted to understand, I understand the three business segment. Thank you for explaining that to us. But let's just understand where the company is essentially. 70% you said would be the contrast media business, if I'm not wrong. How would you want to further navigate this? What would be your strategy going ahead? How would the mix change a little bit from that perspective?
So the strategy, I think, would still remain focused as a. So what's common? So let's just start with this. What's common between these three segments? I think the customer profile that we have across segments, I think they are global leaders in their respective markets, be it imaging, be it pharmaceuticals, be it FMCG. So I think we have a very good customer profile across segments. And the idea would be, in contrast media, we started off with basic intermediates, but over the past 5-7 years, we've been able to make advanced intermediates. So our net realization per kg has improved significantly over the years. In both the verticals, in contrast media and artificial sweeteners, we've seen a healthy CAGR of north of 25%, so which is a healthy growth rate. As a company, we are debt-free with good abilities in capital management. Our OC numbers are north of 30%. Our asset turns historically have been about 5.6x. And the PAT margins are also pretty healthy, which actually positions us in the top quartile of most of the chemical and pharmaceutical companies in India.
All right. How different is your business model from the other chemical and pharmaceutical companies in India, especially the ones with the API focus? How different is your strategy as compared to them?
I think our strategy is very differentiated. And what you also need to understand is that we are in very, very niche segments. The way we have, targeted the segments, and within the segment, the way we have targeted the products, we are in areas where we are not facing for the moment generic competition. If you look at contrast media, the entire space is dominated by 4 or 5 very large innovator companies who have been in the business, the imaging business, for more than 100 years. I mean, this is the medtech industry, a part of precision care, and it's still dominated by innovators and MNC companies. Despite the fact that there is no patent in the segment, there are hardly any credible generic players. So this is a segment which is to a very large extent demand and price inelastic. Similarly, if you look at the high intensity sweetener, one of the large products that we have is saccharin and some of its salts. And saccharin has also been around for more than 120 years. It's one of the most well-established and proven safe sweeteners. And our target segments here again are those which don't see too much of competition from the Chinese and the smaller Indian players. We are targeting the very the who's who of the FMCG sector and the very large global beverage companies and also the pharmaceutical companies. And again, it's noteworthy that we are not aware of any other company that makes saccharin in a US FDA approved facility, although that's not really required. But then we make it in a US FDA approved environment. Both these segments are performance chemicals. So contrast media is a performance chemical and saccharin is also a performance chemical. In the high intensity sweetener, the saccharin segment also, we are working in the niche that I spoke about, and we don't face too much of competition from the commodity players. In our third business vertical or product vertical, as if you wish to call it, there again, as Shiven mentioned, that we are with innovators and we are in the chronic segment, and our target is mostly products which are either in NCE phase 3 or under patent protection or some sort of a marketing exclusivity, where the generic competition is still years away. So that's how we are positioning the company and segmenting the market. We are trying to stay away from generic type of competition so that our margins are preserved and stickiness of business and long-term contracts are assured.
Sure, point well taken. Mr. Singh, let's also understand about the scalability of the business in terms of the revenue CAGR. Totally a 20.5% revenue CAGR was clocked between FY21 to 23. So the top line has essentially increased from a 5,000 crore odd number to 7,200 crore in FY23. How much more scalable is this business? What kind of growth profile can we look at?
So let's just look at the segments first. In contrast media, it's in the medtech industry. The market is growing, and the market is growing in high single digits. And if you will see the industry report, the projections are that the market will continue to grow. Particularly given the demographic tailwinds that we are seeing, the aging population and the high growth and acceptability of the devices in emerging markets. If you look at the high intensity sweetener segment, then there again, the younger generations are very conscious of obesity and diabetes and all these things, and therefore there are demographic tailwinds, and that's again a segment that you will see that there is high growth. Again, in the pharma intermediate side, we believe the focus being the chronic segment, you will see that the growth is much higher than the acute side of the business. And again, both in the developed markets and emerging markets, there's high growth in that segment. So all these three segments are growing segments. There is, the first segment being in medtech, the second segment being in high intensity sweeteners, which are performance chemicals, and the third segment, our pharma intermediate segment, again directed towards the chronic therapy. And all three segments are facing positive demographic tailwinds. So we are in a growth space, and there, given the strategy that we have, I think we have demonstrated over the last 4 to 5 years high growth north of 20%, as you mentioned, and we believe that if we do things the way we are doing, I guess this traction and momentum will be maintained.
So a revenue CAGR growth of nearly 20% from FY23 to 25, given the momentum that you've looked thus far. So you're saying that you're going to be maintaining it going forward too.
Shiven, do you want to add something?
No, I think just to clarify, we're not making a specific claim that we'll maintain this growth journey, but at the same time, what VK mentioned was that we've seen growth in the past, and because of the efforts taken by the company, we've been able to grow much faster than the average industry growth rate in these particular segments. What I would like to further highlight is, as a company, as a CDMO company focused in regulated markets, the key enablers for success is adding manufacturing footprint and R&D capabilities. In 2018, where the company top line was about around 240 crores, our reactor capacity was 230 KL. Today, we've quadrupled the reactor capacity, and the next 2 years, we'll add another 50% to the reactor capacity. So we are in the middle of a strong capex plan because we see some traction in our existing product segments, and most of the capacities that we add are in sync with the customer needs. Because in contrast media, if you see that there are only 4 global leaders controlling the world market of more than 75%, and so in some of the cases, some of the CDMO projects that we do, the plants are co-engineered with our end customers, and this creates a lot of stickiness and also a long-term supply agreement.
All right, gentlemen, I stand to get corrected. 500 crore to 720 crore is the business profile that has grown from FY21 to 23, right?
That's right.
Okay, so how much more scalable? When can we hit the 1,000 crore mark in that case?
We would refrain from making any forward-looking statements at this point in time, but at the same time, the segments that we operate in have a huge addressable market. And contrast media, just to give you a landscape of this industry, today, only 19% is coming from the emerging markets. The rest is in the developed healthcare economies such as US, Europe, Japan, and China. The sheer availability and accessibility of these medical devices such as CT scans and MRIs is driving this growth. So I feel that this is a segment which has huge potential because the increasing awareness to the use of contrast media as a tool for diagnostics, for image-guided therapies, biopsy, is increasing, not just in the developed healthcare economies, but also in the emerging markets.
Sure. Mr. Arora, if I could just ask, what kind of peak scalability has the business in terms of the revenue growth? Sure, you don't want to give a guidance, but what's the peak that the company can achieve? If not for 3 years, maybe a 5-year picture. It's not something which is immediate in nature, but perhaps which is a growth plan and a strategy going ahead.
So contrast media as a segment is a $5.9 billion industry. And today, as a segment, we're just 5% of or less of that. So I think we're just scratching the surface. And today we have relations with these large innovators for more than 10 to 15 years. And the strategy is to be a small partner in the entire growth journey. And I feel the business is very scalable. It's a niche that we've carved out as a company. The CDMO business overall is north of a 80-90 billion opportunity. So,
all right, Mr. Singh, coming back to you, in terms of the margin profile, it seems to have dwindled from 41% to 31% over the last 3 years, so to say. Could you help us understand why have we seen this slide or the deacceleration in the numbers, and what can be expected going forward? Is the 30% number now sustainable?
So, yeah, this is indeed true that the EBITDA levels, they went down. And to some extent, this was an industry-wide phenomenon because the prices of the basic chemicals, they skyrocketed. They became many times of what we were used to seeing. And therefore, our raw material prices went up, our gross margins came down. Similarly, you know, in the last 2 years, we did see the freight also go up significantly, and that was one of the components of the cost. And because of that also, you know, there was a little bit of dilution of profit. As we mentioned that we are in the process of, we are in the midst of a capex cycle, and we are ramping up capacity, and we'll be adding 50% more capacity in the next 12 to 18 months. And therefore, for that, we have to build a lot of execution bandwidth, and Manpower cost also went up. All these factors put together, there was a pressure on profitability. But if you would see the quarter numbers, the quarter one number, because of the softening of the raw material prices, so they have not gone back to the level that at which they used to be, but then the prices are now softening. The freights are also softening, and therefore our profitability is getting back to where it was. Besides, we are doing some vertical integration of a side chain in contrast media that should give some sort of a fillip to the profitability in the contrast media segment. We are also, putting up a solar plant, and it should get operational maybe in the next month or so. And between the windmills that we already have and the solar, we should have 70 to 75% of our energy coming from green. So that should, solar being much cheaper, significantly cheaper, I think that should also contribute a little bit to the profitability. So without giving some guidance, I would say that the quarter results demonstrate that we are getting back to somewhere where we were earlier.
So this 40% profitability is achievable by when? The margin profile that you're looking at is scalable by when in that case?
40% as a benchmark, I think that particular year, because of COVID, the chemical prices were significantly lower. And I would not consider this as a benchmark or a peak in our particular case, in our segments. But Q1 FY24, we've seen recovery in the margin profile back to the existing levels of FY22. And we see a trend reversal in the raw material prices. And last year, the ocean freight was, so this impact was not only for us as a company, but the overall exporters. But we see a strong trend reversal in this particular year, and the margin should be sustainable.
So essentially FY22 growth is at 36%. So that's the scalability that you're looking at, or normalization of trend that you're targeting perhaps.
That's our endeavor.
All right. So this is going to be achievable in this financial year or the next financial year?
So our endeavor is to definitely improve the margin profile, and our initiatives towards raw material supplier mix and everything are inching towards that.
All right, that's a close escape for giving any kind of guidance that I'm looking forward for. But let's discuss about your segmental performance in that case. Contrast media, high intensity sweeteners, pharma intermediaries. We're going to be discussing all about that. But first is the pharma bit, pharma and API, where the revenue CAGR was negative to around 9.8%. I'm talking about the CAGR FY21 to 23. Small part of your business, but what explains the drop in the production for API business? Can you give us more reason and the guidance on how you can look at the segment overall?
See, it's about 5% of our business.
Correct.
So because of the low base effect, even things moving marginally can impact the optics. Well, all I can say is that these candidates that we are working on with are late stage NCs or gaining marketing authorizations. So these are very high value, low volume intermediates at this point in time. But as we scale up and as these molecules get marketing authorizations in their respective geographies, we could see a traction in this segment.
When you say traction in the next 3 years, do you expect this business to be to have a growth figure? Because it's seen a decline of nearly 10% over the last 3 years in terms of revenue CAGR growth. Don't give me a number, but at least give me the path, the guidance as to you think this is going to be a positive growth for the coming 3 years for this business.
Let me just
George at this point in time, but yeah, VK, you can take this up, please.
I'm saying that this business has been in incubation phase, and so we should not look at plus 10% and minus 10%, because we were sending smaller quantities, validation quantities, etc., etc. So, but if you see the first quarter results, I think because some of the opportunities have kicked in, what was an incubation is now fructifying. So you will see that there has been some sort of a significant improvement in the pharma intermediate space, and again, refraining from giving any forward-looking statement, but then there is a big credible opportunity. We have very good, we have a deep product pipeline, and it should do well.
All right, let's talk about your sweetener business in that case. That constitutes around 25% of your sales overall. 33% of your revenue CAGR was achieved from this business over the last 3 years. So clearly, you've been talking enough and more about sweetener business and the potential. How commoditized is this business space? What are the product margins from this segment, and what are your future plans from this business?
So, as a segment, there are several commodity players, but again, the way we have positioned the company and the way we have segmented the market, we are in the FMCG, and so we are in oral care and beverage and pharmaceutical. And in this segment, quality, taste consistency, etc. are very critical. So this is a very, very sticky part of the business, and is more, price inelastic than the other commodity segment of the business. And I think the margins that we have are in line with the other segments, and it's clearly not a dilutive business. Although we don't do segment-wise P&Ls, but the gross margins are in line with the other segments.
Okay, so there is no particular margin differential between this business as compared to your other two business. Just give us a little understanding of how profitable is this business, which is achieving higher revenue CAGR growth in the last 3 years. Is that also percolating down in margins? How can one look at it, and what's the plan going forward?
I think the percolation is quite consistent across segments, because just to give you the performance side of these artificial sweeteners, we were just discussing with some of our customers, and as a company we are really proud about the taste and the taste consistency of the sweetener, and this is one of the reasons why it has taken us many years to get ourselves approved, because certain impurities in the sweetener we control in parts per billion, which contributes to the taste consistency. And we talk about the taste, our customers talk about the flavor, and which in turn becomes their brand identity. So this is very powerful, and this imparts stickiness to the business, because they wouldn't compromise on the price to just to have a cheap quality product, but it's more about the taste consistency and their brand image, and the customer profile is extremely blue chip in this segment, and that's one of the reasons why we enjoy a decent margin profile in this segment.
What do you mean by decent margin segment in that case? Can you put a number to that?
Yeah. So I mean, as I indicated before, the translations of margins in terms of the overall growth has been quite consistent, both in the top line and the bottom line across segments.
Okay, so there is no differential in terms of volume, in terms of margin growth for any of the three segments. All of them have equal growth story in that case. Have I got that right?
Yes.
The margins are in the same band.
Beg your pardon, could you repeat that?
The gross margins are in the same band.
Okay. All right. Let's talk about your contrast media business. Beg your pardon, you've largely been catering to around that, to the iodine-based compounds. What are your plans for this particular division, used for MRI, CT scan-based application? What's your plan there going forward?
You were absolutely right. So our presence in the iodinated contrast media space, which are targeted for X-ray CT scans, has been the focus area for many years. But in the past 5-7 years, we've developed a good pipeline on the gadolinium side of molecules also, which are used for MRI scans. So as a segment, we have about 15 contrast media intermediates, out of which some of the intermediates are in this approval cycle with our end customers. So we have a deep pipeline in this particular segment as well.
Okay, let's focus on your geographical mix in that case. European region contributes to most of your revenue, 74% coming in from that. India and USA at nearly 5%. What kind of mix can we look at going forward? Do you intend to keep that intact at the given levels? Impact of Russia-Ukraine war, how do you see that on your revenue performance for that matter?
So contrast media and pharma intermediates, you're right. By and large, they are focused towards innovators concentrated in Europe and the US. Basically, that's where the manufacturing hub is for these particular APIs and contrast media specifically. See, the customers that we deal with have collectively about 75% global leadership. And that's one of the reasons if we supply intermediates to Europe, our customers at their respective geographies do the API and formulations worldwide. So in a way, we ride the growth journey for the emerging markets also, but optically our sales are concentrated in Europe. And geographical risk, so these are very important life-saving scans, in some cases image-guided therapies. And we saw two black swan events in the past 3 to 4 years. One was COVID, which definitely delayed some of these procedures, and the other one was the Russia-Ukraine war. Despite that, because of this essential nature of this segment, I think the world has evolved in such a way that does not impact the healthcare that significantly because of these events. And in this period also our growth was positive, not just in contrast media, but the other verticals also. So we feel that by and large, the healthcare segment that we operate in should be insulated because of from these global events.
All right. One last question that we have for you in that case is more than 60% of your raw materials are imported essentially from China and Norway. What are your risk mitigation strategies on that?
This is true, but that we are importing several raw materials. One of the about 40% to 45% of this import is for a particular side chain for contrast media, and we have the new capacity that we are adding will be used to produce that as well. And once that happens, I think our import content will go down significantly, and about 90% of our procurement will be local.
All right, gentlemen, we're just going to leave it at that. And thank you for taking out the time and speaking to us.
Thank you.
All right, that's it.